Welcome everybody. So we'll go ahead and get started. If people continue to join, we will be sending out a replay as well. So don't worry if you missed the first bit of it. We will send out a copy later this week. My name is Lauren Wells, and I'm here joined today with Chris Seveny, my co-founder and the CEO of Seveny Investments. Most of you may or may not have heard Chris and I present, whether it was at a conference, met us at a conference, seen us present on a prior webinar, but we wanted to dive a little bit deeper into our backstory at Seveny, who we are, what we do, and our offering specifically. So if you have any questions that come up along the way, feel free to drop them in the Q&A, and we will try to answer them as we go or get to them at the end. And again, we will be sending out the replay of this. So if you need to drop early, totally fine. We will send out the entire recording probably later this week. So that being said, let's go ahead and get started. Like I said, my name is Lauren Wells, and I'm here today with Chris Seveny. And
Hey,
we
everyone.
are to talk about Seveny Investments, who we are, where did these offerings come from, our backstory to getting here, what we've done, where we've been, and our current offering today and how it works. So let's go ahead and start there. We are a Virginia-based private real estate investment company focused on buying and selling mortgage notes. So specifically, we are investing in performing and non-performing mortgage notes that are secured by single-family homes throughout the U.S. We like to say, and the phrase that I will probably repeat a million times once you get to know me, is we fix and flip mortgage notes. So we are buying them at a discount, typically anywhere from 40 to 60%. That gives us the flexibility to modify the loan, work with the borrower, increase the value, and then flip it back to the secondary market for a profit. So we'll dive in a little bit deeper into the weeds later on, but just at a high level, that is who we are. We have over 7 decades of real estate and mortgage-specific experience, and we will talk a little bit more about that here shortly. So because I know everyone always likes to know about the specific offerings, we have our Regulation A offering and Regulation D 506C offerings. You can see here the terms are listed. Accredited and non-accredited investors alike are able to invest. 4-year term, a 3-year term for the Reg D. Minimum investment varies depending on the offering, and then same with the return. I will say on the Reg A, bonus share starting at $25,000 increases that return to 9.07 over the 4 years. So some highlights to our offerings. This is available to both qualified and non-qualified accounts. We pay dividends monthly, which kind of goes to the bottom. It is taxed as a qualified dividend. So for reporting purposes, we send out 1099 dividend forms. So those are taxed as qualified dividends, which are long-term capital gains, which is lower than ordinary income. While total disclaimer, I am not a CPA, so everyone's tax situation is unique. So we always recommend speaking with a tax professional to see how this would directly impact your client and their specific situation. It is not a blind pool. So as you'll see later, we have a current portfolio. We are actively buying, selling, and working out assets, and no fees. So you'll learn a little bit more about the why, no fees. It's very specific to Chris and I's story as investors ourselves. And so we win when investors win. Chris and I are salaried employees of the company, and we only win on the upside after investors are paid. So that is how it works. So we want to dive a little bit into our backstory. So for those of you who haven't met us, or maybe you have heard us speak, it's a little bit more than waking up one day, stumbling into mortgage notes and deciding, hey, let's go the Regulation A+ route into the IBD space and see what we can do. I'll let Chris go first since I've been hogging all the airtime so far.
I was getting good at the clicks, though, from slide to slide. So as Lauren mentioned, we just didn't wake up one morning and decide, hey, let's do a Regulation A+ offering. I come from a corporate background where I was degreed as an engineer. So I'm a numbers person and worked in real estate for over 20 years. And I was an executive C-suite individual within commercial construction and development, and decided it was time to go out on my own. And did that through mortgage note investing, and started mortgage note investing over 8 years ago. As Lauren mentioned, we've done over 600 plus deals. Lauren and I have been together now for several years, where I was going through several of my funds at the time. So we've had 5 full cycle funds in the past, and Lauren came on board, helped me manage those funds. We were extremely successful, which we'll talk about later in those offerings. And then we, did look at this Regulation A and Regulation D offering, and like we wanted to talk about, which we'll talk about later, is really the opportunities we wanted to provide to investors. And that's kind of my quick story. Lauren, I'll let you share yours.
Mine is not as quick, but I come from the probably opposite side, opposite story. Our stories could not be more different. I actually grew up around real estate, and as the oldest of 3 girls, was always thinking that there was no way I would do anything in real estate. I wanted to do my own thing. So I went to university, graduated, and started working at software startup companies in Silicon Valley. And, very stereotypical California, rode 2 startups through IPO. When I went to start a family, I am probably like a lot of investors that you might have, clients that you might have, who think about growing, planning for retirement. I started hearing things like passive income. I started diving into how can I, get another stream of income while I'm working, and cannot take over for daycare costs, our mortgage payment, our car payment, planning for retirement, all the things. So I knew I needed some sort of passive income, and one of my, I'd say, strengths is meeting people and talking. And so I did a lot of networking, met a lot of amazing people in the real estate world, and what gravitated towards mortgage notes because I was familiar with the concept of, buying and holding long-term rentals. But I also live in California, and getting into that market wasn't super cheap. And I wanted to not also have to deal with tenants. So mortgage notes appealed to me in that I could become the bank, and the barrier to entry was significantly lower. Lo and behold, I, used my own capital. I started investing and building my own portfolio of mortgage notes in the second position, because as someone who was just starting out, there was a lower barrier to entry. I could get, a second position mortgage note for, $15,000 versus the first position that, might have to be over 100K, mitigating risk. So did that, built my own portfolio of seconds. Heard Chris and I'm actually at a conference, and I wouldn't leave him alone until he decided to talk to me, essentially is what it was, because I heard him speak all about how you could lose all your money in note investing as an individual investor. And I wanted to learn how to make that transition from second position investing into first position. And we started working together. I started helping him manage his prior funds, which, over 600 deals, as you'll see there. And what struck me, and we kind of came at this together, but was really, wow, 5, 6, 7 years ago, I would never have known that I could have invested in a fund that does this. But I also, when I started my investment journey, wasn't accredited. So, and I looked around at all my colleagues and my contemporaries, my peers at the time, thinking you're, 1 bonus, 3 bonuses maybe away from being accredited, but you have cash. You just don't have access to any of these investments. So really the Reg A and the Reg D were both born from 2 things: making this asset class, which is typically only heard of, you think BlackRock, Blackstone, something that's, exclusive, available to the masses. And then also taking it a step further with the Reg A, making it available in that the minimum investment is $5,000 and you don't have to be accredited. So really the funds came from that passion and our prior experience running the 5 full cycle funds successfully. And, then we'll kind of get into a little more about what we do. So, excuse me. Our mission here is to really democratize investment opportunities. Like I said, making an asset class that is exclusive, available to the masses, both in terms of, something that is not very often talked about. I'd be super curious if I could see your faces and raise your hands. How many times someone on here has ever heard of mortgage note investing as an income option? There you go. Okay, Michael, I'll take it. I love that. But, and then also, giving people the, again, accessibility of, lower barrier to entry to invest with the Reg A. So that's really our mission here. So now we're going to talk about what we do specifically at 7E.
So what is mortgage note investing? So for those that don't, we saw, hand get raised. It's a strategy where you're buying the loan, like Lauren mentioned earlier, we fix and flip notes. We're not buying the physical real estate. We're buying the loan that secures that physical real estate. And we typically will buy these from whole loan traders, private lenders, some banks, credit unions, hedge funds, or brokers. I'm sure everyone today is hearing what's going on in the commercial world with commercial real estate and, the defaults in that. Those loans are starting to hit the market. Now we're on the residential side, so I just want to be clear on that, but to give some insight there. And with a mortgage note, we purchase that, and while Laura mentioned we buy it at a discount, we're still owed that full balance on the loan. So if it's a $100,000 loan, which we'll talk about later, we buy it at a discount, we're still owed that full balance, which allows us to be more flexible with the borrowers to rework those future payments and rework the plans accordingly to the terms. And we'll talk about that a little bit later in our case studies. Anything you want to add on?
Yeah. So one thing I want to mention is when we talk about mortgage note investing, what I like to always give the analogy of is if you've ever owned a home and received a letter in the mail that says, hey, your loan has been sold. Chase Bank sold it to, Bank of America. Please send all your future payments here. We are essentially that letter you get in the mail, and we are the person you would be sending your payments to. So we are purchasing these loans, assuming the position of the lender. So there's really 2 types of notes, or I guess 2 categories of notes. There's multiple, but they fall into typically these 2 buckets: performing and non-performing. So performing is when a borrower is meeting the repayment obligations of their home per the terms of their agreement. So they haven't missed a mortgage payment and they're on time every month. Typically, we are able to purchase these for anywhere from 60 to 90% of the outstanding balance, depending on the interest rate of the loan. And then non-performing is when a borrower has failed to meet their payment obligations and they're 90 days or more past due and they're in default. So typically those are purchased on the secondary market for about 40 to 60% of outstanding balance. Something that comes up a lot here, we get a ton of questions on, is why would banks sell? Why would they sell performing? I mean, non-performing people can sometimes see, but why would they sell performing notes? And kind of what are some of the top reasons banks would sell? So Chris, do you want to talk about that a little more?
Yeah. So one is on the performing side, most banks actually turn around and sell back these loans to a government-sponsored entity. I'm sure people have heard of, Fannie Mae or Ginnie Mae. So in order to qualify for that, the loan has to meet specific requirements. And sometimes they don't. And there's a term out there you may have heard called scratch and dent, where it doesn't meet those requirements. So now the bank or the mortgage company, which is borrowed money to originate this loan, is stuck with this loan that they can't dispose of to this GSE like Fannie Mae. So they will turn around and then put it back on the market. And like Laura mentioned, that interest rate, if they originated it at 3%, like in 2021, and the going rate today is 6%, well, nobody's going to give them full value for that because they could just go originate a loan at 6%. So that is one of the main reasons we see performing, or also from funds looking to rebalance their portfolios. Very common, for example, when we get our loans reperforming, we rebalance our portfolio to liquidate. Non-performing side, like Lauren mentioned, banks typically like to sell those. Banks are not in the business to manage distressed property. They're not in the business to manage REOs or real estate owned property. Banks are in the business to lend and collect the payments. And once it goes outside of that, the box that they play in, it's easier for them to liquidate these loans to then get that cash back in the door to then reissue new loans, which again allows us the opportunity to buy those at a discount. And the discount will vary based on how delinquent it is, the state it is in, the foreclosure laws in that state. So it's a wide variety. That's why you see that big spread.
The biggest question we probably get is, how do we make money in no investing? And really, there are two main paths that it can take. So the first step is, this is kind of that fix and flip model, if you will, laid out for you. So first step is we're buying loans on single family homes at a discount. So again, that's anywhere from 40 to 60% on average. And then there's really two kind of buckets it can fall into. The upper bucket, I guess you could say, is accounts for over about 95% of our portfolio. And that's really, buying those non-performing loans, working with the borrower to schedule a payment plan with them, modify the loan, generating profits from those payments that they're making while they're getting reperforming, and we're increasing the value of the loan. And then once we've done that, we sell that asset for a profit, the borrower refinances or sells the property. Now, something that's important to note here is when I say negotiate a payment schedule with the borrower, I want to be very clear that we are, the first step to get the borrower to come to the table is really to send a demand letter. And if you're familiar with kind of, working with foreclosure, it's the first step in the foreclosure process. So that really gets borrowers to come to the table. Again, about 95% of our portfolio is handled in this fashion. And we can talk all day about, one of the misconceptions being, oh, borrowers just wake up one day and decide I'm not going to pay my mortgage. When, data of our prior funds will show us that it's typically job loss, death, divorce, health, something with their health. And so what happens is these borrowers get behind, the payments snowball, they're able to then, they get another job or they've recovered from their illness, and they're able to go and start making payments again. Well, something about banks is they're not very, very flexible. So if someone's behind 30,000 in arrears, they're going to go to the bank and say, hey, I can make my $2,000 a month mortgage now. And the bank's going to say, well, that's great, but we have to apply this to your past due and your late fees. So it becomes, again, this snowball. They're never going to catch up at that rate. And so when we come into play, what we're able to do, because we purchased these at such a discount, is we're really able to say, okay, you're able to make your payments. Let's do a trial payment plan for 6 months. You make 6 consecutive payments. We will then have you make quarterly payments towards the past due. We will extend the term. We will modify the loan in some way to allow you to stay in your home and continue to make those payments. So that's kind of an example of how we work with borrowers and in what capacity and kind of circumstances that they would come to us. And we'll talk a little bit later about our actual due diligence process. Then the second bucket is this lower bucket here, taking ownership of the home. And that is about less than 10%, I'd say 5 to 10% of our portfolio. And that is when there's typically an abandoned property, the borrower has died, the family doesn't want the property, or in some instances, the borrower says, I'm not going to work with you. I want to stay in my home, but I don't want to work with you. So that in that case, we will go through the foreclosure process. We will then sell the house will then sell at sale. We will be paid off, or we will take back the property and then liquidate it. So something about 7E is we are hyper focused on what we do, this fix and flip model of mortgage notes. We are not in the business of holding onto properties and renting them out. So if we don't take back many properties, as you can imagine right now with the lack of inventory and people wanting to stay in their homes and people wanting to get into homes. So typically if that goes to a foreclosure auction, it's taken by a third party. But in the rare instance that we do liquidate those assets. So, anything to add?
Yeah, the one thing I'll just add is we also get asked a lot, well, who do you sell to? We know you mentioned who you buy to. And on that secondary market, there's a lot of investors who love buying performing loans for cash flow. People who have money in retirement accounts, people who have cash. They're tired of being a landlord and dealing with fixing a roof or fixing whatever it is. So that's one area. And then the other again is, the average person's buying a property every 7 years. So if they sell the property, we get paid off, or depending on the interest rate, they may refinance. Like during COVID, we saw, record numbers of loans with borrowers refinancing. So just another way for us to get paid off.
Yep. So where we've been, so Chris, you want to go ahead and talk about the asset management side?
Yeah, so the fund is acquired over 155 assets, and a typical hold period within the loans is between 12 and 24 months, depending on getting the borrower worked out, getting them on payment plan, getting it seasoned to sell. So as you can see, we've already sold 62 of those assets, and we constantly, after we sell, recycle to buy. We've been in over 33 states, so we're not just in one geographic region. We have a slide that we'll share that kind of shows where most of our portfolio is, which will on the next slide. And one of the things we'll talk about more is the AUM, which is the values of the properties compared to the loans, and we'll talk about that in a moment. And the other is, like Lauren mentioned, some of the modifications we've done on the loans. We've done 19 modifications already to date with borrowers. And that number is, that's by the end of last year. That number is constantly being updated. At this point in time, based on what we're buying, we're probably doing a modification a week right now with a lot of these borrowers. Oh, go ahead, Lauren.
Yeah, so on the capital raise and investor relations side of the house, so we to date have over 500 investors. We've raised over 22 million, and about 22% of our investors have reinvested back into the fund. In this fund, since it's been operating, we have not missed a distribution. And we'll talk about our track record on a different slide before I get ahead of myself.
Okay.
So this is our current portfolio as it sits. So what we were just talking about was this historical of the fund as a whole. This is as of January 1st of this year. So you can see we're in about 28 states, 93 assets, and the total asset value is 58 million. So the average asset value being about 600,000, we'll say. But this is important for a couple of reasons. So if you look at the average UPB, so the average loan that Chris is circling around is 194,000 on a $600,000 asset. And so you're looking at a current loan to value, that coverage of 28%. So, I'm sure many of us have probably heard people talking or are worried ourselves about home values dropping. Here we are, covered substantially. So that is one of the things we really look for when it comes to our due diligence, is making sure that there's ample equity. And then on top of that, 194,000. So that's the loan as it is. Then you take our discount, which is that purchase price down there, that 65%. And so we are purchasing that $194,000 loan for just over $120,000. And am I right? Yeah. Okay,
125, yeah.
$120,000. So we're essentially into that, $600,000 asset, that home. We are invested in the loan it's secured by for $124,000. So that even lowers what we call, you're looking at loan to value, but we use the term investment to value, which is about 20% right now.
And one of the things I'll add is people ask, well, how do you have loans with $200,000 on $600,000 properties? And our focus on our portfolio is we like to buy loans that are 10 plus years old. So we're not buying loans that originated in 21 or 22 that, someone put 10% down on a $600,000 home and now they're in it for 540. They, at the time may have been a $250,000 loan on a $300,000 house. And what's happened over the last 10 years? Home prices have appreciated. And of course, your mortgage, as you pay it, gets paid down. So we like to have that split. And that goes back to why we see 95% of our portfolio not go to foreclosure, because if you have $400,000 of equity in your home and you go to foreclosure, yes, you get whatever's above the loan balance, but typically a foreclosure may sell at a discount. So that is not usually the case. Borrowers want to stay in their home because they also, as Lauren said, they don't have anywhere else to go in today's economic environment.
Yeah, I would say what motivates the question. I'm kind of rattling off questions that I've spoken with a ton of advisors and investors, and I'm kind of pulling from questions that I get frequently. And is, well, what would incentivize a borrower to work with you if they haven't paid in 2 years, 3 years? And really, right now, more than ever, is the economic climate. I mean, people's mortgage might be at 4%. Say, they're paying $2,000 a month, and they can work with us and we can work with them, or they would lose their home. They would probably not be able to find a place to rent because rental rates have skyrocketed, and buying another place would be next to impossible. Inventory is not there, and if your credit isn't good. So borrowers are really incentivized and really wanting to work with us. It's just something they haven't had the opportunity to do because, again, banks don't have that flexibility to work in the capacity that we do. We did have a question that someone popped in that says, the average LTV is really helpful, but I'm curious if most notes are at the average, or if there are any notes that you all buy which are underwater or at much higher LTVs.
There are a few, like when we buy a portfolio, that might be at a higher LTV. And one that rings into my head was this asset in Maine that had a $200,000 balance when the house was worth about 225 to 250. But in that asset, we actually bought it for under $100,000. It was a much steeper discount. So even though it had that high loan to value, we still, on that investment to value, kept it very low. And one of the things we look at, again, is measuring, balancing, risk within a portfolio is, understanding that loan to value and modeling everything out to make sure that we don't overstretch on an asset. Because you have to remember, as a lender, we can't knock on someone's door and say, hey, can we come sit inside your house? I mean, if your bank knocked on your door and came inside, of course you wouldn't let them in. We get exterior valuations done on these properties that we have multiple done, and we're also keep those very conservative as well for those valuations. So if they get closer to that higher LTV, typically we do try and shy away from them. And with the loans being at the age that we like, being 10 years or more older, typically we don't run into that issue.
So why 7E? So just a little bit about our track record. So this is our first offering that has, been distributed in the broker dealer space. However, this is not our first rodeo. We have had five full cycle funds, or 5 funds go full cycle. It's a tongue twister for me. We have over 70 years of combined real estate and mortgage note experience. We've done this fix and flip process on 600 plus loans that we've fixed and flipped, bought and sold. We've never missed a scheduled distribution or lost an investor's principal investment. And we most recently have had a track record verification report done by an independent third party that has verified our net return to investors across those 5 funds as 14.5%. So just a little bit about our track record in this space with this strategy.
And
so
one thing
go ahead.
I was going to say, one thing just also mention about that track record is, again, we've been doing it for many years now. So we've seen different cycles as well with, the ramp up in, kind of actually was slow in 2016 to 18 where it was high, through COVID and through today. So it's not as if this is something that we've, like you mentioned, 600 plus loans over a very long period of time. So we've seen a lot.
So why 7E? So I'm going to walk through the 4 below, but really we always talk internally and with people, with, some of our other investors, about our 3 uniques, and they kind of fall in line with these things. And something that's really important is to know that first, we purchase these notes at a steep discount. That 40 to 60% really gives us that flexibility to restructure payment plans and flip the note for a profit. The second is really the market opportunity. And this is something, this is part of kind of ties in alignment with that mission to make it accessible and available to the masses. So, it's $1 trillion that's actually, I think, to be honest, a little outdated. I think it's like 16 trillion right now, in market opportunity, single family residential debt with 2 to 5 million, or $1 billion, floating around in non-performing debt. So what we're doing as far as our specific assets we're looking for, our buy box, our strategy, we're not looking to be BlackRock, Blackstone. We have ample opportunity, ample inventory to look at and kind of cherry pick what works best for our portfolio and our strategy and the returns we're looking for. To talk a little bit more about that market opportunity, over the last year in 2023, now that we're in January, so last year, we went from seeing at the beginning of the year 300 million in a quarter across our desk to bid on, and by the end of the year, we were looking at 300 million a week to bid on in loans. So really, the inventory is there, the market opportunity is huge, and we are just looking to capture a smaller piece of that. The third part is we are very selective with our due diligence process, and I'll let Chris speak to that a little bit more in depth. But a big part of that is really our team. So, and I want to speak to this because I come from this industry as an individual investor. So when I got into this, I told you earlier, I didn't want to, be a landlord. I didn't want to deal with tenants and termites and toilets. However, something I wasn't prepared for getting into this space as an individual investor, building my own portfolio, was how much hands-on work it would be to make sure that you were quickly fixing and flipping notes. It was much more of an active play than I could have ever imagined. And this is important because unlike other funds or sponsors, our asset management team is in-house. So we have licensed servicers that we work with in every state, as is required by the CFPB. But as far as pushing things through the process, managing the tactical decisions behind what we can offer borrowers, that's really all done in-house. So it allows us to move more efficiently. It allows us to move quicker. And really, when Chris talks here about that due diligence process, it allows us to be more thorough and more hands-on with exactly the assets we are looking to acquire. So with that, go ahead, Chris.
Thank you, Lauren. And as Lauren mentioned, due diligence, and with my background in construction management and development, you really focus on the team, which is important, and managing that process internally, as well as how do you mitigate the risk with anything that you're doing. And we like to say we focus on the 3 Ps in due diligence: the property, a person, and the predicament. And when we talk about property, it's twofold. It is the condition of the property. We send people by the property, they take photos. You can tell by the exterior, typically, okay, if the grass is 3 feet tall with a broken window, something probably we're not going to be interested in. Whereas, cut grass, a seasonal flag out front, Halloween decorations, people have pride of that home. So that's a good way for us to get some sort of valuation. But the other thing with property is, we're buying the lien and understanding what is that lien position. Like we talk about first position mortgages, first position means you are, essentially the first person to get paid from that property. So we want to make sure that is the case. We want to make sure it's not in a second position or junior position. We want to make sure that taxes are paid, because taxes could sell and wipe out a mortgage. And we use a third-party firm that manages all that for us. So it's very important to us to go through the property. And then with the person, it's understanding, a quick background check on the person. How many times have they filed bankruptcy? Do they have a criminal history? What is, kind of the context to this person that kind of falls in line also with the predicament of, what happened. As Lauren mentioned, typically death, divorce, medical are kind of, the 3 primary. And as Lauren mentioned too, people just don't wake up one morning and say, I'm going to stop paying my mortgage today. Usually something happens, but also when dealing with banks banks have so much red tape where somebody falls behind, it takes 6 months to get an answer from them. Well, they just fell 6 months more behind. We work with borrowers one-on-one, which is what we roll into next, and focus on each individual loan, where we work with the servicer, who is the point of contact with that borrower for compliance purposes and making sure payments are properly calculated. But when a borrower comes to us and gives us a package, it's okay, we want 10,000 down and $1,000 a month as an example, and they come, I can only afford 8. We literally can get that answer back to them instantaneously. We don't need 27 different people approvals. We have a investment committee that will review that and give it its stamp of approval on the spot or counter, whatever it may be. So I think that is one of, again, those big differentiators that our team internally also knows the model for what is profitability on a loan. If someone says, hey, I'll give you $50 a month, unfortunately, we know the model, that might not be the case. Again, with larger institutions, that person who's doing that negotiations probably does not have that information.
Yeah, and I want to add to that because it's very important when we're working with borrowers to fix and flip the loan. But the fact that our team is in-house and hands-on, and we have that investment committee reviewing our portfolio, bi-monthly, is the ability to track loans as they're progressing against how we modeled them. So if we see things aren't hitting certain benchmarks, we get to make that decision earlier rather than later. Should we sell this loan if it's not progressing at the pace at which we need it to? So just another way of having that in-house team and eyes on assets at all times, that we can mitigate risk, not only by having the amount of assets, but also the thoroughness in evaluating them on a continuous basis. So I think that's important to understand.
And being a data junkie that I am, not only is that, but we also analyze data to the point of, is it taking a little longer in a state? And we update our models. Is it because of that attorney? We rate every single consultant as well, and are constantly working through our models to make sure that everything is accurate and even balancing that portfolio. And like Lauren said, do we hold it? Okay, we can get more money if we sell it now.
Why this mortgage note fund? So it's that, passive cash flow without the headache. You're managing the assets, mitigating the risk by diversifying, which is actually number 4. I skipped ahead, and allowing investors to receive those qualified dividends. Again, it's not that ordinary income. There is profitability in varying market conditions. So typically this market, the mortgage note space, the secondary mortgage note space, does well in a downturn market. We are seeing an increase in inventory, which allows for, us to cherry pick, be pickier about what we want and get better pricing on the acquisition, which allows us to then have more flexibility to work with the borrower in creating repayment plans. The collateral and equity. So it's real estate. It is secured by single family homes in our case. And so, like we mentioned earlier, LTV is around 30%, our investment to value around 20%. So it is secured by physical property. And then, like I mentioned earlier, the versatility and diversification. So when it comes to mitigating risk, you're not tied to one asset. Your investors aren't going to be tied to the outcome of a single note. The risk is spread amongst the entire portfolio. And then something that drew me to this asset class originally, and Chris, I'm sure even more so, was the numerous exit strategies. So, it's not, okay, this is how this is going to go. And if it doesn't, we lose. Really, we have the ability to kind of manipulate things along the way and adjust to anything that might be a curveball thrown at us and still make it a win. So.
Yeah, and a few things I'll add, again, like you mentioned, Lauren, about the market conditions. It's really not correlated to other things in the market. Interest rates, which we can talk about, not significantly correlated to those, not correlated really to the stock market. It's, jobs is probably the closest correlation, where higher unemployment would be higher defaults. But when you look at our models, and then with the home values and how we buy loans, we feel we have plenty of ample opportunity and flexibility to work through those. The other, like you mentioned, is that versatility and diversification, because we're not leveraged. Like other real estate asset classes, we can exit these loans at any point in time. It's not as if we're leveraged and the valuation of an asset has gone down and then we're at the mercy of a third-party lender in that instance. So that also, or it causes a delay in exiting those assets or that single asset. Because we have 90 plus assets in our portfolio, it allows us constantly to buy and sell. So
we want to
also,
walk you through a case study here. Go ahead, Chris.
yeah. So this is, I'll use the term, our bread and butter for the type of assets that we look at. And this was an asset that we acquired last spring in Arizona. And this one had a balance. It was only a $50,000 balance on a $600,000 asset. So you can see considerable equity in this. And basically paid right around that 60 cents on the dollar, 32.5, and it was non-performing at the time. And the borrower was about, a little over 6 months, between 6 and 9 months behind. As Lauren mentioned, we typically send that demand letter, which we did in this instance because our servicer wasn't able to reach out to them. And this is not uncommon because when a borrower's behind, they're getting that statement. They're just thinking, okay, now I don't even want to open it to see how much I owe. So it typically just gets ripped up and thrown in the trash. But if it says from the law offices of XYZ, usually it gets them to, jump a little bit more. And in this instance, once that demand was sent, the borrower who had temporary loss of their job essentially had a new job and was getting a bonus, which they received, and they end up making all those payments and got back on track. And then after that, they continued to pay, and we then turned around actually a week and a half ago because this loan got reperforming, and turned around and sold this loan for a little over $35,000. So we're able to essentially on this loan sell it for a profit of over $12,000 on a $30,000 investment in essentially 9 months, to give people an idea. So this again scales, for whether the balance is higher or lower. This is again typically the outcomes of our loans. This one was 9 months, and sometimes it might be 12, sometimes 15. If they file bankruptcy, could be a little bit longer, but this is a very typical case study. Anything else you want to add, Lauren?
No. Actually, yeah, well, not to this
Okay.
case study, but one thing we get asked a lot is about interest rates. You mentioned it briefly about, how do interest rates affect this, or like how are they correlated to how does that affect your, when you buy assets? So it really doesn't have a direct impact, because when we buy assets, we're buying and bidding based off of a specific yield we're looking to attain. So the example I always like to give is if we're looking for a 12% yield and the loan is written at 6%, we're going to need a 50% discount on buying that loan. If it's written at 9%, we're going to need a 25% discount. So again, it really just varies and depends on the yield we're looking to achieve and adjusting our bid accordingly based on what the loan was written at. So interest rates, regardless of what they are, don't have a direct impact on our ability to acquire assets. Now, if you've made it this far and you listen to Chris and I talk and you have more questions, always feel free to reach out. You can reach out to me, Lauren at 70 Investments, or you can reach out. Molly Boyce is heading up distribution and capital markets for us. You can email her. Her email is here. Many of you might have spoken with her already. It's Molly Boyce at 7E Investments. And I am sure if I have not met you, I will be meeting you probably in the near future. I hope to meet you. I'll probably see some of you at the conference coming up here in the next couple of weeks. So again, thank you guys so much for joining us. If you have any other questions now, feel free to drop them in the chat. If not, we will be trying to host some sort of webinar monthly for advisors who are interested in learning more about who we are and what we do. The next one will be in March, and I believe we are going to be talking about either case studies or frequently asked questions we get from advisors. So still TBD. If you have any thoughts on that or interested in hearing something specific, please email us because we don't want to waste your time. We want to make sure that what we're speaking to is, we all have busy lives, families, activities, hobbies. And so we want to make sure we're making the best use of everyone's time. So if there's something you're looking to hear more about or less about, feel free to shoot myself or Molly an email, and we'll make sure to plan that into our upcoming webinars. And then just to recap one more time, I didn't remember this slide was here. You have the Regulation A and the Regulation D offerings. You can see the terms listed here, just really same portfolio, different lockup periods, minimum lockup periods, investments, and returns based on investment size. So one thing that I did not mention that does come up from advisors is about the commission. So on the Regulation A, the commission is 4%. On the Reg D, it is 5%. So without any other questions, we'll go ahead and end it here. Thank you guys again so much for joining us on this Thursday afternoon, and I hope to meet all of you soon.
Thank you all.
Thanks. Bye.